Hey guys, welcome back to the Falaya Focus Podcast. Today, I'm excited to have Steve Keighery on. He is the founder and owner of Homebuyer Louisiana, also HiPages, where he built up a sales team and marketing team that was a home improvement kind of, we'll get into it, but startup, which is something that I'm obviously enthused and want to learn a little bit from him today about. So we're excited to talk about real estate and everything that he has going on. How's it going, Steve?
Yeah, really good, man. Thank you. I'm really excited to be here and chat more.
When did, I guess, timeline, so you came here in 2018 or
yep,
so.
2018.
When did you start HiPages, or when was the starting, you graduated, and then the timeline to that?
So I graduated in 2002.
2002. Okay.
So then I had my own business there. So it was a solo business for about a year. Then about 2004, I would have merged with my partner. That's when we met the guys. My partners had the natural therapy site, and I was starting the home improvement site. So we actually worked together for 2 years as our companies weren't combined, but we did a lot of joint ventures, and we attended expos together. We had complementary skills, and then we formally merged into the business in 2006. So the business started in 2004. We merged into it in 2006, and in 2018 was when I left, and that's when I came on to New Orleans for a 6-month vacation.
So 12-year drive of that.
Yeah,
that's a lot of work.
Man, yes. It was. Yeah, it was. Like, it was exciting, hard work. I loved it. I don't think I want to do it again. But I don't have the same ambitions to like build a business to the same scale. But I loved every second of it. I think I was pretty naive. So like I left, like I was dumb. Like I was young and dumb. I honestly, like, leaving and starting my own business, like I was convinced I was going to be in Australia. It's a BRW rich list, maybe it's a Forbes list. Like I was convinced I was going to be successful. How, like I had a lot of self-belief, but I'll be honest with you, I probably shouldn't have. I didn't have the skills to back it up, but that belief powered me, and I thought I'd exit faster. We, through different times of building our company, we felt we had this high valuation, and we got insulting offers, and people didn't see it. So the fact that I thought it'd be so easy kept me powering. And I think it is that old saying, right, that people, they overestimate what they can do in the short run, but they underestimate what they can do in the long run. And I think I did experience that. So I think I thought it'd be successful much faster. But in terms of what we built at HiPages, like, man, probably underestimated that. Like it's an amazing company. I'm very proud of it. The goal is to make it $1 billion company. We got to $500 million valuation. It has gone down a little bit since then, but I still think it's on path to be that. One of my partners is still the CEO there, and he's doing a great job growing the business. I have some shareholding in it, so I'm not operational, but I get to, like, I'm just like any shareholder. I get to listen to the reports and updates, and I'm really excited about what we're doing going forward.
That's very, very cool. I can attest to how difficult it is to drive a business into the market. People think that that's an easy feat. When you first get started, you're like, if I build this thing, all these people are going to come, and it's just going to be, you're kind of first-time founder, first-time business owner, and you don't realize the work that it takes to get it into the market and push it into the market is extreme.
It's hard.
It's really hard, and it's almost everything you got.
Yep.
And even that, it may not be enough.
Yep. Yeah, it is. It's a lot of work. It's a lot of risk, because you throw everything into it, and you need to, like, keep growing, and, like, you can get disrupted. As much as like we operate with supreme confidence, and like we in our ability in our market, but like things can happen that come out of left field really easily. So, it's risky, and but it's also very rewarding, and you take that risk because you have that high upside.
Yeah. So you, during that process at HiPages, you built up a sales and marketing team, right, of people that were reaching out and onboarding these people. Can you talk a little bit about how you built that culture and some things that I or the listeners could take away from that?
Yeah. So my I was in charge of sales and marketing. I had some great partners. Like, one of my partners is a Mark Zuckerberg smart programmer, like vision, product wise. One of my other partners who's the CEO now, he's a CPA and financial and stuff. So we had good partners. Sales and marketing was me. We were very much in the early days too, like sales really drove our business. We were like, sales was everything. We had a very good sales process, and where we would, it was really a 3-step process. We would have a cold calling team who would call contractors. So our business is a 2-sided marketplace. We're connecting contractors with homeowners. So I'm assuming there's a more American market, very similar to Angie's List, Home Advisor, those it's pretty much that business in Australia. So we're connecting those people. So on the contractor side, we need to have the contractors on our platform so that the homeowners get a good experience. So we're very aggressively signing up those contractors. It was in those days, honestly, like we were calling them, talking about the internet and Google, getting them on Google, and the conversations we were having was, what's Google? Right. Like, for real? Oh, that's a fad. Like that was the conversations we were having back then. And I mean, in 2006, it's not as if Google was brand new or anything, but just the contractors hadn't adopted it in the same way.
Shoot, they still haven't. Really.
Exactly right. So we would call them and put them on a free 30-day trial. We would call them in the middle of that trial to onboard them and help them. And then we had closers who called at the end to do sales. And we had a really good process. We honed it, optimized it, and it generated a lot of sales. Those sales from a business perspective weren't really profitable in the first sense. Like, we really just covered our costs. But once we acquired those customers, the renewals that was really profitable because we would prove value and we could connect. And since then, we've built things like auto renewal, and we've had a lot of different changes to the business model over time, and now it's much more efficient and stuff. But sales was driving it. How did I drive that team? We had this thing where for me it was important that every day was different, and every day was the most important day of the year. That was my standard. I like it. And we mostly achieved that. I mean, it's hard. It's a hard bar to hold, but we had a really motivated team. We had good incentives for them. So really, I think the thing that really allowed me to power on was salespeople are motivated by commissions. Yes, sure. And they'll tell you they want consistency because they do. You mess with their commission structure, they're gonna get mad, right? But they also hate it because you give them this. If the commission structure is always the same, it's boring. Sales can be boring, and we were very high transaction. We're really high transactional sales, so it can be boring. So the trick was we made it a game. So we had a standard commission structure that was the same every month, but I had a budget that was our kitty, which was like I could make up the incentives. So every single day I would do a new incentive, and it was always different. It was like I might put people in teams that compete against each other. Might be individual, or might be, hey, we might put 10 envelopes on the wall with different amounts of commission in it, and we'll be like, hey, for the first 10 sales gets to pick a commission thing, and some of them we had a high amount, some of them might have been a high five from me, so just inventing a lot of things to make it invigorating for the staff. It was like, oh, this is what I found was when the commissions worked, you'd do it again. It didn't work as well because it just became boring. So by mixing it up, it just made things really interesting for our team. And so we really drove Coach R through that, through the incentives, through just, I'm a real positive person. I'm high-fiving. I'm getting, we're not really cracking a whip. Hey, make sales. We're creating an incentive. There's a carrot, and I'm going to help you. I'm going to motivate you. I'm going to drive you. And we had a really, really strong sales culture. I think the best in the country. Yeah. Personally.
Yeah, that's cool. Changing it off can be, because I mean Jacob can attest, but making those cold calls or reaching out to the folks and closing the deals is not a very fun endeavor at times, and it can be very rough, especially with us because we're calling homeowners. And the homeowners have been called by people, we're going to get into your business. And they've been called by me. They've been called by other agents. So they're kind of tired of the phone call. So it's, and we could get into that in a minute, but changing it up, that's something that I didn't think about, because I have been in other businesses where it was like that, and people do get complacent. They almost expect it. It also becomes an expected incentive and not something that entices you.
There's a gamification part of it, right? And and again, the salespeople, they sort of won't like it. Like it's not they want to have the same structure. They want it, so they want stability. So don't get me wrong, they want it in their head, but they're gonna get bored by it. So it needs to be so you need to give them something that's like stable, but then you need to they didn't always say they liked it, but they liked it.
So the economy, right? Economies can drive businesses. Like, was the economy in Australia tracking basically with the U.S. economy in the crash, and then you came and built that business out of the crash? Did it affect the Australian economy as much as the U.S.? And then how did that affect the growth of your business and your sales to where you got to the exit?
So we call it the GFC. I think like the global financial crisis,
right.
07, 08. We did have that. I think we did better than the US. We did do stimulus checks like they did in this round here. But it was tough. It didn't really affect us though. I think we actually benefited because we were taking market share and we were offering value for money. So our main competitors were the Yellow Pages. I don't know if that's the same. Back in the day, it was the Yellow Pages. I don't know if that's the same thing here, but they had a monopoly for a long time. They had that big yellow book. They charged a lot of money to advertise. It was pretty stale and boring. So we were coming along at a much lower price range. We were giving them like full web pages, online presences, like phone calls, jobs. So like I think it hurt those people, but the money actually started navigating towards us, and we just kept executing. We were just growing market share, continually listening to our customers, adding more value. So we just powered through it. I guess the companies that already had the big market share and they were like dominant, I think those are the ones that hurt.
So on the sales, like how you charged, was it mostly at the beginning? It sounds like it was kind of transactional, or was it reoccurring revenue and then changed, or how did that change? Talk about that.
It's evolved a fair bit and has continued to evolve. So when we first started, we really were just we really took the Yellow Pages and made it like online, so gave them a full web page, and it was still a directory though. There was some issues because we charged a flat fee. They could buy extra areas, but we did hit an inflection point. I don't know if you're familiar with the S curve, where you grow and then you hit this point where it's hard to grow more. And we were such a sales-led organization that we realized to keep growing. Like we got awards for being a fast starters, fast growing company, but we realized to keep growing at that pace, I would have a whole building full of salespeople. You know what I mean? We had 90 people at one point. So we do it 90 people about now, and we would have had to just keep increasing that. And that didn't make sense. And so we did a couple of pivots that really set up that next S wave of growth. And there was two things we did together that was transformative for the business. We realized there wasn't a relationship between traffic and value we were generating and what we're charging people. And what I mean by that, there was a flat fee. So you might be a roofer who's doing lots of jobs, and getting people are making so much money from their small, modest advertising. But you also might have some local handyman who's not doing that much and he's doing okay, but proportionally they were doing a lot different, and we were charging the same amount. So we would increase our price every year, and it's but we're never charging the right price, because as we increase the price, this person who wasn't getting that much, it was too high for them. But it was still way too low for this person who was killing it. So that was a problem. So, we wanted to create a relationship between traffic and revenue. Gotcha. So we did create a pay-per-lead product. So we moved from just flat subscription to where they could pay for leads we're generating. And at the same time, there was a consumer problem we're solving. So the consumers, we were better than Yellow Pages. It was better than looking through the book, but it was still a directory. And what we found from research with the customers, we would show them these 10 people with nice photos, etc., but they would call them and maybe only one of them calls them back.
Got you.
because they're busy. They're contractors.
Yeah, they're putting down the tile.
They're on the tools.
Putting up the wood. Yeah, they're on the ladder.
Most of these people aren't like, they're not sophisticated businesses. They're trades. They work with their hands, and you know, like some of them were sophisticated and had those businesses, but a lot of them weren't. So we developed a post a job functionality where instead of looking through the directory, you just say what you wanted, and we would on the back end send out to the contractors to see who's available. Yeah. And those two things together were really, really powerful because the consumers just got a much better experience, and we drove jobs, but then we charged for the leads. So as we increased the jobs, we were making revenue. Gotcha. So when we did that, we could really turn up our marketing. So we were doing a lot of Google advertising back then. And we were actively trying to increase. We got to $1 million a month in Google spend, and we were active, but we were chasing that because our team, when they drove the right kind of jobs, we had data scientists and there was different. You got to drive to the right places, right? But if you drive jobs to the right places, those businesses make a lot of money and they'll pay us the money. So our spend was driving revenue, and we were actually pretty happy. We were trying to grow aggressively, to win that market. So we didn't mind breaking even. So we would even go up to a break even on our marketing, because when that consumer uses that contractor, they get on our database, because they might find this plumber now, but then they need an electrician and need a trash removal. We had a whole suite and a brand. So we were fine to break even on the job. So it allowed us to really increase the marketing spend. But we pivoted away from that too, because there's issues with that as well, right? So problem with a pay-in per lead, a lead's never worth what you charge for it, okay? And what I mean by that is a lead's either worth zero because you don't convert it, or it might be worth $10,000 if it's if it's a nice job for you. So it's never priced perfectly because you can't. So we would educate our contractors about, you got to look at it as a group. You got to say you buy 10 leads, and if you get 2 or 3 of them, you spent X and you got Y, and that worked to a level, but it was still hard work. So we then developed a new product. We're like, hey, we have to change that. So we developed a value cap, which is more subscription and is monthly recurring revenue. So they would get lead credits. That was another game changer, because it gave us more stability because monthly recurring revenue. Right. So we knew we could allocate budget. And it took away from the contractors. They were thinking less about, because what we found is someone's complaining, oh man, I spent X amount of money on this lead and it was crap. And you're like, cool, what about these other leads? Oh yeah, I got that job. You're like, dude, did you look how much money you made? And so as soon as we moved to a monthly subscription, they were thinking less about the lead
and more about the monthly fee, and did I break even on return on investment? Exactly.
Yeah. And we've continued since I've left now. We have gone even deeper into that, and now we're doing a lot more SaaS. Like we're helping the contractors with workflow management, creating quotes, scheduling, because these people, they don't have a lot of that infrastructure. So we're continually leaning into improving the functionality for our contractors and for our homeowners, and that's our role as a two-sided marketplace, similar to yours, right? Yeah. You need to reduce friction for both sides of the marketplace. And we're making money and we're a valuable business because we're making life easier for both those groups.
Right. That's interesting. Yeah, I mean, it's really tough, trying to manage that, right? When you got two-sided marketplace, I mean, Falaya, it's really difficult for us to figure out a way. Right now, we're kind of like where you started. That's why I asked the question. Yeah. Because we're kind of at that transactional flat fee. We've got these ideas of these builders, flippers, and REITs that could be more reoccurring revenue, X amount of listings per year, type of deal, and then get transaction support all the way through. So it's interesting how you morph from the transactional to the SaaS software, and Level Set. Scott Wolf had the same thing. When he started out, he was flat fee, you get a lien in this, and then he grew into a SaaS business for these big contractors, right? And so it's interesting how you progress. I just love to hear that from you. it definitely, because I'm trying to figure out how to progress.
Yeah, you need to figure out a bit as you go and where the blockages are, because it's hard to jump straight through to the SaaS, So and the fact that we were generating leads made us valuable to the contractors. That's sort of like that got us in the door, and then from there we could morph into the packages. But we also knew how, like, we had a lot of data. So for me, I think you need to get traction. I think people can get very concerned with optimizing everything, but you need to get some traction. And the traction generates data, and then from the data you can make better decisions. So because we'd been doing all these leads, when we moved to a subscription product, we had all the data on all the businesses. We knew who to call. We knew like we had our data scientists too. Like, we had all these different cohorts of, like, this person, like, call them and offer this price, because we know they're getting it's value for them. And we had segments to everyone to call. So sometimes you got to get that data. You just got to push it forward. We very much probably the biggest thing we learned in our business was the value of MVP, minimum viable product.
Sure.
So I mean, we grew to a level. We ended up having a lot of resources. Like product managers, data scientists, developers. So we had a lot of really good people, which was helpful. But we had to be conscious not to over-engineer things, because
for sure.
You don't want to start with pretty much everything we did start in a spreadsheet. We got, regardless of our posted job, that whole function, which was pivotal to our transformation, we literally started. The job came in and went to a spreadsheet, and we had someone manually create it and send it out, because we didn't want to over-engineer it. We wanted to prove that jobs were actually coming in. I learned this from Atlassian. I don't know if you know Atlassian. They're an Australian company. They're listed on the NASDAQ. And we went to a presentation they did, and their product manager talked about MVP. But what really hit me, the way he said it, he's like, you have 10 ideas, 10 of your best ideas, 9 of them suck. Right? And they're your best ideas. You're the ones that guarantee these, 9 of them suck. You need to live with that. And it was true. Because we have a lot of ideas, we generate great ideas, and the truth is that a lot of them don't work. So if you can execute that idea in a real easy way, create a landing page. If you think all the people are going to sign up for something, the engineer team want to go, okay, great, we're going to create these things, this workflow, and they're going to create this big workflow. It's going to take months to build. Whereas you might do that, and then you had that landing page, no one even fills in a form.
That's right.
So I'm put the landing page up, get someone to fill it out, even if it goes nowhere. Just make sure once you have 10 people fill it out, now you know it's working. Now build the rest of the flow. So I think that's always important. So you need to minimal viable product, don't over-engineer, test, see where you're getting results. And when you get results, that's when you go hard. So it starts in a spreadsheet, but once you're getting traction, you go really hard into optimizing that flow and turn it into something big.
Yeah, I completely agree with that. It's a hard edge to roll between minimal viable product, because sometimes what people call minimal viable product is almost just trash. So but to your point, you're just trying to prove out the business concept. It's not really a software term.
Yes.
You know what I mean? It's more of a business concept is how you're trying to explain it. When you're trying to build an app, sometimes I see these people pushing out these apps that just nobody's ever going to use. Right. And so you don't want to build it till you know it's there, but at the same point, you got to try to get it to a level where people actually use it, Yes. And so it's a hard thing to get right,
Yes.
And I'll tell you, I'll be firsthand that I've built stuff for Falaya that have not worked out because of COVID and other things, and I didn't know how the world was going to work, and I was trying to pivot for the world instead of my business, and I've learned now you just have to learn what's good for your business, what's good for your product, what's good for your customer and your users, because at the end of the day, that's the most important part of the puzzle.
Yep.
And if you get that right, don't block out the noise. All these people go and they chase the next shiny object, especially in software.
Yes.
And so you've got to guard against that. And I think that's what minimal viable product is trying to guard against, is chasing those shining objects.
Yeah, you want to go where the data's telling you things are working, and you want to get a bit of traction on it, for sure. And we very much were into growth hacking, and we what we did well was we established growth teams that were multidisciplinary. So like we had sales in there, we had marketing in there, we had developers. You know, we had a product manager. Product managers were awesome. They were linchpins in our business.
I need one of those.
They are.
I got to get one, man. I mean, I need a product manager like it's going out of style. Like, because I am the product manager and I'm not the best one. Man. You know what I mean? And I'm all right, but I'm too busy, man. And it's just, you can't do it all as a founder. You think you can, but you can't. You know, it's just not viable.
Product managers are my favorite people. They bring all the, you know, and also too, I'm not a technical person myself. So like, I mean, like my partner was very technical. So we had a lot of technical people around us, but like me personally, I'm not technical, but like that product manager is just a bridge. So like sitting with the product manager and developers and like they just create stuff. And when you do it right, when you're, you know, we would do stand-ups every day. We would have urgency and like, what are we doing today? Like, go do that. Like, we'll report back. How'd you go? Like, and we'd test. We'd create a growth team around a metric. You know, metric might be jobs posted through the system. A metric might be revenue. It might be, you know, just one metric. And we're just like, honestly, and we'd sit and go like, we'd brainstorm multidisciplinary team. What are some ideas? No ideas are bad. It's like, let's just put all the ideas of how we can move that metric, and then we'd get them all and would start to rate them, like what's high impact, you know, what's high effort, you know, and would create grids. And so everything that was high impact, low effort, that's what we're doing first, and that's on the list. And like, go do it, you know, right? You know, anything that's high impact, high effort, it's a project. It's going to be backlogged, and you're going to try to do it. You know, anything obviously low impact, high effort, you're never doing that.
Yeah, right.
Low effort, low impact, you know, rainy day. You know, hopefully you never get to that. It hits a backlog, but hopefully you don't get to that.
Yeah. Right.
But just with the idea around moving a metric, and we're focused on a metric, and we do something. Didn't move the metric. It didn't. Cool. Throw it away. Next thing. Like, right. But when it starts moving, you get addicted to that growth. And that's empowering for the team to make that metric move.
Did y'all raise funds for HiPages? Talk about venture raising, or did you raise anything in that? Or is it all bootstrapped to the?
No, we've had a few raisings.
I mean, you obviously went IPO, right?
Yeah, yes.
That's the be all end all.
That was a big raise, but we had a few raises. So in the early stages, like after I merged into the company, we actually had basically a business plan. Like I said, we had this sales process where we'd put them on trial, you know, and sell them. And like I said, it didn't really make money, but it started to make money in the renewals. So we had a business plan that showed, hey, in 5 years we can self-fund and would be here. Exactly. But then what we did was, like, of course, while we want to do that, we're trying to like race, because there's competitors, right? You need to take the market. So we then took that plan and said, well, cool. What if we just raise money and hire all those people today? And that's what we did. And that's when I really grew the sales team, because I got empowered to hire a lot of people, and we pushed and we raised money. It was through my business partners network. We had some really good early investors. They were very established, you know, gray-haired people, you know, who had businesses themselves, like very successful businesses in Australia. They used their own money. So they were the first round of investment that funded the sales. They also created a lot of structure for us, because, you know, before our board of directors was 5 of us who were all partners, right? So then when they invested, like, they were on the board. So we had to have the board meetings took a different meaning, you know, they were less relaxed, which was good. We needed that corporate governance, and they really helped us step that up. And then we did after a while, we sort of outgrew them after a couple of years, and we raised some money and bought them out, and we brought in more younger tech investors. You know, one of our investors was Right Click Capital, and they raised money for a living. So when they came on, they helped us with our next raises and position us for the next ones. And we ended up we got News Corp invested in us. They bought 30% of our company.
Wow. Okay.
That was pre-IPO. So that was our third raising. I could be wrong. But they came in, they took 30%. We were able to do a bit of a secondary, so I was able to sell some shares into that.
That's great. So that's when you got a little bit of.
And so got some money.
You got
out.
your money out.
Yeah.
That was on the series, maybe, or what was it? It was kind of hard to tell.
Yeah, I don't know.
The money came. And,
yeah, it's also too, like we've become more sophisticated in Australia since then, but Australia wasn't as sophisticated as like the ecosystem America has on entrepreneurship and like raising money is much easier. It was really hard to raise money when we started, and I think about it. I think it was a blessing, right?
Right. I mean, that's what I said that on the call today when we were talking about me losing that 2020 idea pitch, and I didn't get the money and I didn't raise any money during COVID. And I was like, it's probably a blessing in disguise that I didn't raise the COVID money. Because if I had raised COVID money, I would have gotten an outrageous evaluation. You know what I mean? Because money was free. It was at 2.25, you know, like, so they were giving it away. And so I would have been overvalued, and then I would have ran out of money by now, and I would be undervalued, and I'd be full ratcheted as a founder. And I'd be in pain. You see what I'm saying? So believe it or not, I think it's almost a blessing that I've been where I'm at, but I'm in a great position to expand right now. And so that's why I'm interested in to hear what you guys say. Raising
money celebrated, right? Because it's a big deal. And it's a big deal. You feel good. It gives a good PR, but it's like, that's when the work starts. Because the raising money, like you got to use that money. And I think the other side of it too for us is because, by the way, Australian ecosystem is really good now, and we've got a good tech scene. But just when we were just a little bit ahead of that, and it just was harder. So we raised up money. It was really good through my friends' network. But they were good business people, and they helped us grow. But there wasn't all that tech money out there. If there was, and there is now, it's so much easier to raise capital that you have to raise it and you have to spend it fast because you're racing. So it's like when everyone's raising money, you got to raise that money, spend that money, and you're all racing. And only one of you is going to win, right? So I think the fact that it was hard to raise money, but we did it, and what we're doing was hard. It was good because like everyone wasn't
creative friction.
Although there wasn't all these new startups chasing us, we were ahead and we were pushing through. We were doing very difficult things. Even our sales process was so hard to. What we did was, it's not efficient. The calling we were doing and the selling, it was not an efficient process. But the fact that it wasn't efficient meant that no one else was doing it. And we did it, and we built it, and we built a big moat. We're very hard to beat now because we have this contracted database. We've built relationships with over years. Like, it's very hard to get that, and I don't think you can replicate what we did now. So it's sort of like, you know, that's why it was harder to raise money. But we didn't really do the ABC. We didn't have all that sophistication. We just raised a couple of times. You know, we did get more sophisticated later on, and you know. I drove sales and marketing. I wasn't really doing the money raising. So, you know, my partners might say there's more sophisticated.
They might be able to speak better on it. Yeah, you don't want to overspeak. Yeah, definitely.
But then we did that, and we said that obviously the IPO was a big deal. And that's really when liquidity came home, and, you know, like people were able to exit, you know, sell shares when you want, small amounts, and that's a good thing.
Let's move into real estate, because that's really why we're here. We're both real estate guys. I guess kind of tell us a little bit about Homebuyer Louisiana and what all it does.
So Homebuyer Louisiana acquires distressed properties. So we look for properties where we can add value. We'll do a lot of wholesaling. So where because we're always marketing, we've got a whole bunch of deal flow, and wholesaling is very much to me a two-sided marketplace, like I did back home, right? Where we will get a deal from a home seller who, you know, needs to sell a property, it needs a lot of work, and we will negotiate a price. But if we don't close on it, we will assign our contract to. We have a really big network of buyers which we've onboarded, spoken to. We know what they buy, so we might give that deal to them, and we'll earn a bit of a margin in there. So we'll do that wholesaling. It allows us to market aggressively. So we're constantly looking for properties. I do buy myself though. I do like to buy rentals. I like the BRRRR method, which I mentioned. So the BRRRR method is where you buy a property that needs to be fixed up. You buy it cash, you fix it up, you put a tenant in place, so you rent it out. And then once it's stabilized, you refinance it. Because the bank they'll generally lend you about 75% of the after repaired value. So if you buy it discounted, because you buy it when it's distressed, and you put the money into fixing it, Whereas a flipper would normally sell that property at that point, and they'll take that margin of what the value they've added. So for the BRRRR, instead of selling it and taking out and getting taxed capital gains, right? You refinance it based on 75% of value. And if you do it right, you can generally get all your money back. But then you have the asset, and it's the rent the rent covers the mortgage. And I've been getting I put on 30-year fixed debt. So for me, I'm shorting the dollar. I'm shorting the American dollar is my view of that. Because we know inflation.
100%. I mean, real estate is a hedge on inflation. I mean, there's no doubt about it. It's the best store of value.
Mixed with that 30-year fixed.
With the pay down, with the principal pay down, it's just a because I mean, property is inflation hedge, right? But if you buy a property and in 10 years, let's say it doubles because of inflation, right? So it doubles. But also the cost of gas doubles, the cost of food doubles. So by having a property, you have protected your money from inflation, but you haven't got ahead. Where you really get ahead is with a 30-year fixed debt. Because if you have 30-year fixed debt in 10 years' time, your payment's still the same. And rent's gone up.
The rent's gone up, the value's gone up.
That's the kicker.
That is really where you get that benefit. So I love that 30-year fixed debt, and your viewers may not know, right? Like, it doesn't exist anywhere else in the world. I think Americans take it for granted. There is no such thing as 30-year fixed debt in Australia or anywhere else in the world, right? The most they'll fix is 5 years, and it's really the Fannie and Freddie really back it. So it's almost subsidized by American government. So the 30-year fixed debt, Americans take it for granted. It is the greatest thing in the world that's inflationary. Even the Fed, I mean, we've had the 9% inflation. We've seen how bad it can get. But even in normal times, their goal is 2%. They want 2% inflation. So, if you can buy an asset that increases with inflation, with money that is actually benefits because that's devaluing the debt gets devalued, that is the greatest play. So that's why I love the BRRRR, because I'm using my money, I'm buying it, I'm taking it all out, and I'm just leaving that debt and that property and that asset, and that's beautiful.
It is beautiful. It is absolutely beautiful if you buy it right.
Yes, you got to buy it right.
Which he is the Homebuyer Louisiana, right? So you got to buy it right. I think that's the biggest thing, like in real estate, period, is getting used to knowing the market, know what to buy, what to pay for something. And that's for any real estate people that are going to listen to this. I've bought things wrong. That's why I'm saying it.
Yep.
It's not because I'm smarter than you. It's because I've been around long enough to know a little bit of thing or two.
I bought some wrong too. You got to make some mistakes. That's how you learn, right? That's how you learn. Yeah. But you've got to buy right, and that's for me, what I've enjoyed is that, like, I've built these skills in my company in Australia, these sales and marketing skills.
Right.
And I use those to get properties, because I'm not a rehabber. I'm actually not a good property person. Like, that's not my skill, but I'm great at sales and marketing. So if you're great at sales and marketing, that means you can get the deals. And if I can get the deals, I can pick the easy. So I generally tend to buy not the good deal. All my deals are good because I'll wholesale deals. All my deals that I wholesale are good deals. I'll generally keep the easy ones because of my skills. Like, if there's foundation issues, if there's a massive rehab, my skills aren't great at that. So I'm going to assign that deal to a rehabber who that's their skills. They don't want to do sales and marketing. They just want the property to work on. So I'll assign that. But when the deal comes and it's like, it's not too big a rehab, I love buying properties with problem tenants because I can deal with tenants. I have property managers. So, like, I can fix a problem tenant. I can fix a messy, dirty, hoarder house, so I'll take those myself, turn them into rentals, refinance them and keep them. And I'll wholesale anything that's like real structural or just a big rehab I can't do.
That makes sense. I mean, you definitely need to know your lane and what you want to buy in your buy box and be true to yourself, right?
Mm-hmm.
Because I think a lot of people, when they get into flipping or into real estate investing or buy and hold, is they buy themselves like a job, and it's a really, really risky job.
Yeah, for sure.
You know what I mean? And then they end up making a mistake, and they really regret it. But I mean, if you stay in your lane and you know what you're going to do, then you can have more success.
Absolutely.
But I have never done a BRRRR. yet because it wasn't really. I've been so focused on Falaya, you know, and the Burr really came about when COVID. I mean, it really got popular during COVID because it was so easy to make a cash flow.
Yep.
Because the money was so cheap. Are you seeing that Burrs are harder to do now because of the interest rates increasing, or?
Yeah, they definitely are harder because, you know, it relies on 30 fixed debt. So, you know, if the debt's, you know, 3%, 4%, that's helpful. Now it's higher. So it is definitely harder to do. Insurance is a big factor as well because it's not just the debt that's expensive. The insurance in many ways is worse. So it is definitely harder. I've personally been doing less Burrs recently, but also I built a pretty decent portfolio. So the thing about Burrs is, and rentals in general, unless you're buying them cash, if you're buying rentals with debt, they don't do a lot for you today.
No, none. As a matter of fact, rentals today, because we just had one, we just replaced an AC on a rental, and that was a heavy hit. We had an electrical issue on another rental this week where it backfed into the rental and the tenant was touching something that was shocking them. And it was Energy's fault. Energy had rigged up the pole wrong after the hurricane.
Yep.
And so it's just, I mean, in other words, you're never really making money today. If you're trying to make money on a rental, it is not the right thing to do. It's long-term wealth building.
Yeah, over time, the rents will increase. You know, with inflation, the rents will increase. Like you'll start to, after a few years, you're going to start to get a bit of separation. You're going to start to make some money. And then as time ticks on, you can make more and more and more, and you're going to pay down your debt too. So, you know, you're paying down that loan. So the value's going up and the loan's paying down. So rental properties is a really good way to build wealth, long-term wealth. It's pretty simple, it's guaranteed, but it's not, if you're expecting to like buy a couple of rental properties and be cash flow rich and retire, it's not going to work that way.
I mean, the insurance right now, let's talk about that because I sell properties all over Louisiana, Mississippi, Alabama, all over the Southeast. And I'm telling you, this insurance thing is a serious problem. We were selling 2 properties in Slidell, and I mean, it was all we could do to sell these properties. I mean, and these aren't expensive properties, Steve. These are properties that are $190,000, $150,000, should usually sell fairly quickly in decent shape. These aren't high-end homes, but it ends up being like some of these people were paying like $800 a month in insurance. And I mean, this is on a $150,000 or $200,000 house. Like that's half the note, you know what I mean? Or more of the note, you know? And so it's getting to the point where it's such a big piece of the note that it's almost unfavorable to live there for some of these low income earners. It's tough.
I mean, that's why transactions are dropped, not prices, because people that don't have to sell. And probably the other level to it is like, again, about this beautiful 30-year fixed interest I'm talking about. It also applies to the homeowner because, you know, everyone refinance, like so many people have 3% interest. I say 2.5% interest rate. So even if they lost the difference between 2008, right? There's mass people lost their jobs, but they were all on variable interest rates. Therefore, like they sent the keys in. The reverse is true now. Everyone has these low fixed rates. So even if you lost your job, you're going to fight to keep it. And often you can deliver Uber, you can get unemployment benefits. You might be able to make that note payment because if you sell it, the alternative, if you go rent, it's more expensive. If you that note is beautiful for an investor, as I discussed, but for the homeowner, they're also hedged against inflation. They're locked into prices from a few years back, which were significantly better. So again, why would I sell? Why would I sell and rent? Why would I sell and get another 7%?
There is no point. I mean, why would you sell? It doesn't make any sense. Like, what are you going to move into? Half these people, like even some of these high earners that I have that are buyers of mine, they are making a lot of money as lawyers, doctors, and all this. They don't want to move because they're going to literally pay 3 times, even though they want to go buy their dream house, they have to pay 3 times the amount per month, and they just haven't gotten to the point where their life change or their amount of babies or something hasn't pushed them to feel that pain. Even though they have the money, even though they have the ability, they don't want to buy because why would you? You know, you're hanging on to this. It's almost like the loan is almost more valuable than the house.
Absolutely.
You know what I mean?
It is.
Like that's the reality of it.
It is.
You know, and that's what's driven this subject to thing to the forefront, is because of that power of that loan.
Yeah.
And it's only growing bigger and bigger. So what are your thoughts on subject to deals? Do you do any, or your thoughts on it? I know we're both connected to someone that does a lot of them or is involved in it. But I'd love to hear your thoughts.
So I do subject to loans, but I will. So I have mixed feelings. So I buy subject to loans a little bit. It's not my preference, but like I do see deals. I looked at ones before we came here, which I'll probably buy subject to. So I do buy them subject to. I am a little concerned with what I see in the market of subject to though. I'm a wholesale. I do wholesale, right? I would never wholesale a subject to. I don't, because you're taking over someone's loan. And, you know, if you're telling the seller you're taking over a loan and you assign it to someone else, if that person stops paying, like they're going to call you. So I don't think you should assign a subject to. If you want to do something, you can maybe wrap the note. Like we did a subject to of someone we know actually, and the deal went bad from the people we sold it to, the rehabbers, and they stopped paying, right? But we had given them a lease option, and we're still paying the person we bought subject to, and it's been vacant for a few. We're paying them. We just took possession. We're fixing it up. But the person that we bought subject to, we're making the payments every month because we said we would. If I had have assigned that deal to these other people, they're defaulted. That person would have been in trouble. So I do have an issue. I don't really think you should assign subject tos unless there's a lot of transparency. I do think it's getting a bit hyped in the market. Like multifamily was the big hype and syndication a few years ago, and that's gone bad. I think subject to is a big hype right now. Everyone's getting into it.
It's a shiny, bright object. I do believe it's very much like we were talking about earlier, like the shiny, bright object in real estate right now is subject to, and for good reason. It has a lot of value. Yeah. I mean, there's, you know, if you're transparent and you're upfront with the person and they understand the risk and you understand the risk and everybody's going in the same boat, it could be very advantageous for both parties.
Both parties, absolutely.
Both parties, win-win. But it needs to be transparency, right? Yep. The thing that worries me about sub 2 is that there's just becoming too many people doing it. Like it's almost becoming very well known and very much on social media, very much courses and classes, and it's becoming very, very, very popular. And when that happens, transactions that are subject to are going to increase. Now, if they increase to the point at which they are a large market share, which they're not right now, but say that gets to 5% of the market, 10% of the market, or something like that. I mean, these banks, they need turnover of the paper. And so my thing is, if you get stuck between the bank and the paper, you know, they don't want these low interest rates. You understand what I'm saying? It's not advantageous to the bank. And so
it does depend on the bank though. So I don't most if it's a local portfolio lender, yes, most of the loans get securitized, they get sold off. So
sure.
So once they're sold off, the banks don't have a shortage of money to lend you at high rates because they create money. They lend money into existence. I don't know if you're familiar with the Euro-dollar system, and like I won't go too deep, but the banks make up money. They invent it by loan. They loan it into existence. So they don't need to call a loan due to make another loan. They can keep making loans. So I don't think they're going to chase it down because the interest rate differential, unless it's a local portfolio lender. That's a different story. But most of them are like they're sold to a servicer. It's a bond in the market. They want to keep getting the payments every month, not get the money back.
It is a bond in the market.
But I do think the issue though is in that popularity. They're bringing a lot of novices into the market because everyone's selling courses. So someone does a course and the person they did the course from might not be good, or someone just they watch YouTube, they think they can do a subject to, and they do a terrible deal. And I think that's the problem. So subject to is a great strategy. I think it can really help a seller. It can really be a good deal for a buyer. The problem is the popularity is leading to a lot of novices, and it's leading to a lot of bad deals that I see, you know. So I think those bad deals will happen, and that's going to give subject to a bad name. And you know, so I think the problem is in the novices executing in the popularity right now.
Yeah, there's no doubt, especially if they don't understand the risk. I mean, you definitely hear the stories where they do come calling them, and so I think you got to be very careful, and you definitely have to have an exit strategy, just like in any real estate transaction. You got to have multiple exit strategies, and that one's for sure, because if the rainy day does come, which it can come, and I've heard that it's come, and so the question, and I don't have the wherewithal to just absorb that quite yet, where on multiple properties, say there was like 5 of them that hit me at one time, I'd be dead in the water. You know what I mean? If it was one, maybe I could weather it. But if you can exit it real quick and sell it or refinance it into another deal, then it's no big deal. So if you have those things in place and you tell them that's what you're doing, I would definitely be setting up bank accounts too, to where it was an automatic draft. It kept all parties safe and secure, and they knew that there was at least a month ahead or something like that, and they could view it or see it,
that's the key.
And if you can do something like that and be transparent with them, it could win. Because, I mean, dude, who doesn't want a 3% interest rate?
Absolutely.
I mean, it's going to cash flow, right? I mean, it's going to cash flow. So, I mean, if you can pick it up as a rental, it's a no-brainer.
I've got a couple like that, and I like them. I got one I bought in 2020, which is 3.25% interest rate, and it's getting old. It's amortizing. It's beautiful.
I just wonder, like, how do you think that's gonna like pick up? Do you think that like people are gonna, if interest rates go? I personally am on the bandwagon that interest rates are gonna go up, not down, depending on what happens today.
Interesting. Okay.
Depending on what happens with this election, I think that's gonna be a big factor, but. If there isn't a revitalization in the markets, and I'm really on the bandwagon that we're more like what happened in the 70s into the 80s. I don't know if you've
they had the second round of inflation.
Like I really think that we're in like that type of curve that they've been trying to suppress, but it just won't happen, and I hope that they can keep it around 5 and 6, but I worry that it might go to 9, 10, 11.
Gotcha. I think that's definitely a probability, but I don't think so. The rates aren't. What I'm pretty certain of, the rates aren't coming back down to 3%.
100%.
5-6% would be a good rate. And I think there is data nationally that it's when the rates came down to 6%, the pre-purchase applications started to go up. So I think there's a lot of benefit of that increasing, but I don't think it'll go up to another round of inflation. I think we'll be safe, but that's definitely something you should I think people that thinking this is what's going to happen, I think that's a wrong thinking. You're thinking probabilities. It's like you might have a base case that I think this is most likely, but that's absolutely possible. So I don't agree with you, but I think it's possible, and I think you need to have a plan and think through what happens if that does happen.
That's right. I mean, I'm not 100% sure what's going to happen. Nobody does. If we did, we'd all be we'd be killing it. You know what I mean? And we'd be predicting things and trading stocks and everything. But at the end of the day, I just, I think that low interest rate is so enticing, especially as the spread gets wider and wider. You see what I'm saying? Yeah. That's what I was trying to point out here. Is like when the spread is 2%, 3% to 5%, it's only a couple points. I mean, subject to, is the risk worth 2%? But will normal buyers, like what Courtney's doing, trying to educate agents and normal buyers about this, like if the interest rate goes to 10, the spread between that is
significant.
7%. Mm-hmm. You see what I'm saying? When will that, if that happens, what would that do to the market? Like that's where I'm interested to see if it really takes off and grabs a large market share, not just like investors like you and me that are savvy, that know this or that have talked about it and learned it and studied it. Will it become common stance? But interested to see how it plays out. Sure. What's your thoughts on the real estate space over the next 12 months? What do you see happening?
I think it's going to be slow, but improving. I think transactions will pick up a little bit off the base, but I don't think we're going to take off. So, I think it's going to be, just better than 2024, but not setting the world on fire. Unfortunately, I really would love to see transactions pick up. I think for everyone, even if for most people who are agents, title attorneys, mortgage people, like you'd prefer prices to drop and transactions to go back up. Like so.
Oh, I mean, we're paid on a commission. Yeah. When you drop the price, we only lose $200 to $300 in commission. I mean, we do lose some, but not enough.
And the transactions feed the economy because people are moving. There's movers. There's like all the ancillary services.
There's so many services. I mean, we have like, I think in our pitch deck, there's like $40,000 worth of purchases that somebody makes that impact the economy on one move. Yeah. It's unbelievable.
So I think it'll pick up a little bit, but just slowly. I think we had it's almost like we had a decade of growth in the 2020, 21 and halfway through 20, like just the growth of price value and like we had that pop. I think the thing is be slowly improving. I mean, inventory is rising. I think it needs to rise. The inventory is risen, but it's still below. So it feels bad because the market's slow, but like it's still below where it was pre-COVID, and ideally it needs to get up there. So I mean, I think that does need a bit of slowness. So I think it's going to be a better year, but nothing to be super excited about.
Very political answer from you. I love it on today's great thing. One last thing. I mean, what are your thoughts? Do you deal with any commercial real estate? What are your thoughts over commercial in the near future in that space?
Like multifamily or
multifamily. Any of it? Yeah,
I don't do a lot. The biggest unit I have is a sixplex. But I mean, if we talked about the excess of subject to, I think there was excess in multifamily previous to that.
Absolutely.
And again, multifamily is a great asset. It's a great business. There's lots of good operators. Like
it got overpriced.
It got again, it's the same thing. I think the novices, like saying it got exciting. So like every man and their dog were doing syndications. The prices were going up. Less experienced operators, the real good operators couldn't buy it. They didn't buy it because they were priced out. So I think there's a wave of pain of all those inexperienced operators with the interest rates coming up. So I think there is pain coming.
I do too.
But asset-wise, they're great assets. The thing is, the interest rates have stopped new build. While all the buildings are coming online now, there is a glut of supply coming into the market from all. It takes like 2 years to build, right? So there's a glut of supply, but all the building has stopped. So there is going to be, I think we're going to feel some pain. Supply, people are going to have trouble, but that market's going to pick back up because no one's building.
I agree with that.
Probably a good time to buy, to be honest. Like
great time to buy.
Start circling. And
if I had cash, I would be a buyer.
That's the one thing. This is the one thing I'll leave you with too, because I think it's you have a different perspective on the market, because the market, everyone will say the market was awesome in like 21, let's say, right? Depends, right? It was awesome. If you mean you had properties you were selling and you had them already, yeah, it was awesome. They were selling fast, over asking, beautiful, right? But if you were buying, it sucked, right? And so now it's just the reverse. If you have this asset you're selling, yeah, it's tough to sell. It's a great time to buy. So you're never going to have a great time to sell and a great time to buy. So we're just in the different season. So I think if you want to get in a property, I'd be buying right now. If you're buying to flip, let's do it, but just be careful and be conservative. But if you're buying anything medium to long term, buy.
I would agree. Yeah. I completely agree with that. I think people overpaid astronomically in the COVID years, and then the adjustable rate mortgages are going to come due 5 years in.
Balloons.
That's why balloons and 5 years in. I mean, you're basically looking at 2020. If you did it in 2020 or 2025, it'll come due 2026. I think it's going to be interesting the next 2 years in that space. And there might be a lot of opportunity
for sure.
For buyers to take advantage of that and take on the market.
For sure.
Well, is there any last things you want to say, or I guess kind of tell people, how to get in touch with you if they do have a distressed property and all that?
If you go to distressed property, Homebuyer Louisiana is my website, or Google me, you'll find it. If you're looking for deals, reach out to me. I have deals regularly, so I can get you my buyers list. I do run a meetup on the West Bank in Gretna, the West Bank Real Estate Investors. I run that with Emil Hurst Jr., who I think's been on your show.
Yeah, he has.
So look that up on Facebook. We have a meetup on the second Thursday of every month. It's a good place to meet me and lots of other investors.
All right. Well, I appreciate you coming on, man. And we'll see you next time